If you're serious about trading, you know that backtesting is essential. Otherwise, you're just gambling. Backtesting allows you to test your trading strategy on historical data to see if it's profitable. The problem is, most backtesting software is expensive and complicated. Well, not anymore. In this video, I'll show you how to backtest a simple trading strategy in 15 minutes or less with easy-to-use tools. To trade successfully, it is essential to have a clear understanding of the market and the underlying security. This can be difficult without access to quality historical data and the ability to backtest your trading strategy. Fortunately, there are many software programs and programming languages that can help you in the process. Here are some of the things you need to backtest properly. A trading strategy based on solid research and economic fundamentals, a good broker or data vendor that provides quality historical data, a software or programming language that can be used to create the backtest, and a reputable broker that suits your needs. When talking about trading strategies, this can be something as simple as a buy and hold strategy or a more complex technical system. Today's successful trading strategies can be found in books and investment newsletters. The key to finding a good strategy is finding one that has proven to work over time. You will need access to historical data for the securities you want to trade. I've personally used high-quality vendors such as Bloomberg and Algorithmic. The thing is, these vendors are not cheap or accessible to the majority of people, so I'll do this tutorial using data exclusively from Yahoo Finance. Many different programs are available, ranging from expensive specialized software to spreadsheets. However, I'll use Excel to keep things simple since most of you are already familiar with the program. And regarding the broker, just ensure you can implement your desired trading strategy live. With these things in place, you can test your trading strategy and better understand how it would have performed in the past. But wait, there's still one thing to consider before starting your backtest, and that's the backtesting methodology. I believe that a quantitative approach to backtesting yields the most robust results, so we'll focus on such approach for this tutorial. Here, the two main types of backtesting that investors use are research-based backtesting and event-based backtesting. Quantitative analysts use research-based backtesting to test specific trading strategies using historical market data. This analysis lends itself to complex calculations, algorithms, and machine learning methods to accurately simulate how a strategy would have performed during specific periods under different conditions. In event-based backtesting, the procedure is carried out in the same execution loop as a trading platform's execution algorithm itself. It seeks to correctly simulate market data and exchanges so that a more thorough assessment of a trading strategy can be carried out. In this tutorial, we will see an example of research-based backtesting. But don't worry, you don't need complex algorithms or machine learning methods to assess all trading strategies. That being said, let's jump to the good stuff. In this tutorial, we will assess the performance of a simple long-only strategy for Apple. That is, buying and holding a share of Apple for a specific period and compare it with the performance of a market-neutral strategy. The logic behind this strategy is to see if it is possible to get better results from a solid blue-chip stock if we are not subject to market fluctuations. Our holding period will be from December 23rd from 1998 to December the 9th of 2022. We will assume that the average risk-free rate is 4% per annum during this period. Moreover, we will download the daily prices from Yahoo Finance. We will specify the date range desired and store them as an Excel file, which we will call aapl.xls. The next steps in Excel are as follows. First, you start by opening an Excel file just like this one and paste information from the CSV file we just downloaded from Yahoo Finance. If you have problems downloading the data, I will upload a copy in the video description along with the complete backtest. As you can see, the file should have columns A through G filled from the download. In case you got the data in descending order, meaning newest to oldest, you can sort all the columns in ascending order of date by using the sort function in the data tab. In cell H3, you have to type equals F3 minus F2 over F2. This is the daily return. Once you have done that, you can double-click the little black dot at the lower right corner of the cell H3 as it will populate the entire column H with daily returns of Apple. To keep our spreadsheet neat and clean, we will type daily returns in the header cell H1. Now, in cell I3, we will type H3 minus 4% over 252, which is just the excess daily return assuming the 4% per annum risk-free rate, and 252 since those are the average trading days in a year. Again, once we're done, we will double-click the little black dot at the lower right corner of cell I3 to populate the entire column I with excess daily returns. And to keep everything organized, we will type excess daily returns in the header cell I1. Moving on, in cell I6034, basically the second empty cell below the last row in this column, we will type equals square root of 252 times the average of our range in column I over the standard deviation of the sample of the same range. The number in cell I6034 should be 0.74329593, which is the famous Sharpe ratio of this buy and hold strategy. Before discussing this number and others, we will continue with the performance of our long-short market-neutral strategy. This may sound like a complex strategy for the layman, but it is a straightforward twist to the buy and hold strategy we just covered. When we bought Apple, we will suppose we shorted an equal dollar amount of Standard & Poor's depository receipts as a hedge. In this case, they will be represented by SPY shares, and both positions will be closed on December 9th, 2022. You can also download SPY from Yahoo Finance and store it in an Excel file called spy.xls. We will go through very similar steps as previously covered for Apple. If needed, we sort the columns in the SPY file in ascending order of date. Then, we will copy column F, that is the adjusted close price, in the SPY file and paste it onto column J of the Apple file. As an intermediate step, we will check that column J has the same number of rows as columns A through I. We will perform the same steps as previously covered to calculate the daily returns in column K. Order is still essential, so we type daily returns SPY as the header in column K. In column L, we compute the net returns for the hedge strategy as the difference between columns H and K divided by 2. We divide by 2 because we now have twice the capital since we showed it the stock of SPY. In cell L6034, we compute the Sharpe ratio of this hedge strategy the same as with Apple. We should get 0.752638888. So far, so good, but we need more metrics and a Sharpe ratio to see if this strategy suits our needs. We will continue the preceding long-short market neutral example to calculate the maximum drawdown and maximum drawdown duration. The first step is to calculate the so-called high watermark at the close of each day, which is simply the maximum cumulative return of the strategy up to that time. Using the cumulative return curve to calculate the high watermark and drawdown is equivalent to using the equity curve, since equity is nothing more than the initial investment times 1 plus the cumulative return. Moreover, from the high watermark, we can calculate the drawdown, the maximum drawdown, and the maximum drawdown duration. So, in cell M3, we type equals L3. In cell M4, we type equals 1 plus M3 times 1 plus L4 minus 1. This is the cumulative compounded return of the strategy up to that day. We proceed by populating the entire column M with the cumulative compounded returns of the strategy and naming this column cumulative returns. In similar fashion, in cell N3, we type equals M3, and in cell N4, we type max of N3 and M4. This is the high watermark up to that day. We populate the entire column N with the running high watermark of the strategy and name this column high watermark. In cell O3, we type equals 1 plus M3 divided by 1 plus M3 minus 1. This is the drawdown at that day's close. Again, we populate the entire column O with the drawdowns of the strategy. In cell O6034, we type equals the absolute value, the minimum value of the entire range of column O. This is the maximum drawdown of the strategy. In cell P3, we type if O3 equals 0, then 0, else P2 plus 1. This is the duration of the current drawdown. We populate the entire column P with the strategy drawdown durations. In cell P6034, we type equals max and our entire range for column P. This is the maximum drawdown duration of the strategy. It should have a value of 1168, that is, a maximum drawdown duration of 1,168 trading days. Graphically, we can see the results like this. When backtesting a trading strategy, it is important to have realistic expectations. A backtest is not a perfect predictor of future results, but it can give you an idea of how your strategy might perform under real-world conditions. Many factors can affect the results of a backtest, including market volatility, liquidity, and slippage. As such, it is important to consider these factors when interpreting your results. The Sharpe ratio measures excess returns relative to risk and is a good indicator of risk-adjusted performance. A high Sharpe ratio means the strategy is more profitable, while a low Sharpe ratio means less profitable. The Sharpe ratio of our strategy may not seem impressive, but it is quite decent if we consider the different economic cycles in the past 24 years. Moreover, this strategy has a higher risk-adjusted return compared to the long-only strategy. This fact points to the benefit of not being subject to market fluctuations. Here, our metric for risk is volatility, where volatility is a measure of how much the return on investment varies over time and can give an idea of the stability of returns. A higher volatility means the strategy is riskier, while a lower volatility means it's more stable. In this example, the long-only strategy had an annual volatility of 40.9%, whereas our long-short market neutral strategy had an annual volatility of 17.14%. Finally, the maximum drawdown measures the peak-to-trough decline in an investment's value. This is the most significant loss that the strategy has had over a certain period and is a good metric for assessing risk. Again, A higher drawdown means the strategy is riskier, while a lower drawdown means less risky. Our long-short market-neutral strategy had a maximum drawdown of 47.71%. This number can be hard to tolerate if you had invested all your money in this strategy. Likewise, we have a maximum drawdown duration of 1,168 days, or a little more than 3 years. However, considering this strategy had a long-term horizon of almost 24 years, those 3 years may be much more tolerable. That being said, our results are pretty sterile, since they assume that all of our trading activities are free of transaction costs, our orders always get filled, and we are diligent enough to keep our strategy intact. When conducting a backtest, it is crucial to be aware of these limitations to interpret the results accurately. In the end, a backtest can only provide information on how a system would have performed in the past, and does not guarantee future success. A more realistic usage of the metrics the backtest provides is to take the results as an upper bound of what we expect of a particular strategy. Hence, it is of utmost importance to avoid corrupting our backtest. As we have seen, backtesting can be an important tool for traders and investors to assess the potential profitability of a trading strategy. Yet, even experienced traders can make costly mistakes during backtesting. One of the most common errors is look-ahead bias. This is when a trader considers events and data that were not known at the time of their backtest trades. A clear example would be to use either high or low prices when testing performance of your strategy. Not only can this cause inaccurate results, but it can also lead to poor trading decisions. Another significant mistake to minimize during backtesting is data snooping bias, or overfitting the data with too many variables. While it's essential to account for as many factors as possible, when testing a strategy, adding too many variables can lead to false signals that do not reflect actual market conditions. This will create inaccurate results and likely lead to losses on live trades. You can minimize this common mistake by testing the strategy on multiple periods, and also by eliminating as many parameters that aren't vital for the strategy's performance. Likewise, a mistake that often occurs during backtesting is failing to consider regime shifts. A regime shift occurs when sudden changes in the market environment may cause a profitable strategy from one period to fail in another period. For example, this can happen due to new regulations or technological developments, among other things. Transaction costs such as commissions, liquidity, slippage, and market impact should always be accounted for when testing strategies, as they can significantly reduce the overall profitability if left out. This tutorial presents a simple and short backtest, so I intentionally omitted several factors to keep this tutorial accessible for everyone. This whole process may seem long and tedious at first, especially to check if a basic strategy has the performance you seek. So, is backtesting worth the effort? The answer to this question depends on what you're trying to achieve with your trading. Backtesting is a superb way for traders to evaluate the effectiveness of their strategies, allowing them to adjust and improve their strategy before risking real capital in the market. While it does take time and effort to backtest, it can provide invaluable insight on how a specific strategy performs over different market conditions. With a demo account, traders can access historical data to replicate the same trade conditions that occurred in the past. This allows them to analyze and measure how well their strategy would have performed during the backtesting period. The more data points included in the backtesting process, the better informed traders are about potential outcomes. Backtesting also helps identify potential issues with strategies that may have otherwise gone undiscovered until live trading began, potentially saving traders from incurring losses if those issues had not been identified earlier on. Backtesting is not an exact science, and there will always be several risks involved. Yet, if you stick to your plan and follow its rules, you can increase your chances of success. Otherwise, check this video to learn more about why you fail at trading. Spoiler, it's not always a matter of financial knowledge. Overall, backtesting can be a helpful tool for evaluating trading strategies before committing significant time and money. After everything we've covered, what do you think about backtesting? Have you done it in the past? If so, how did you perform your backtest? Please let me know down in the comment section. Be your viewer. This is Eric from Markats, and thanks for watching.